Alright, hello everyone. We're going to be talking about some up-to-date policies and data. It's going to help you on your exam. We're going to get you ready. We're going to look at all the goals. And then some budget stuff. And the interest rates. Just trying to get into the vibe. Feel free to skip ahead. We are going to look at some data. That was pointless, but I enjoyed it. Hopefully you did too. Just getting a different vibe going. We're going to be talking about all the different data from the VCE exam that's going to be important for you. We're going to start off with economic growth, which is goal of strong sustainable economic growth is the highest growth rate possible without running into any unnecessary inflationary, environmental, or external pressures, measured at a rate of about 3 to 3.5% real GDP growth per annum. If we look at economic growth happening right now, we are currently at 9.6%. If we want to look at that as data, that is your most current data. Obviously, that is way above the goal, far above it. But in terms of achieving the goal, it's not unsustainable at the moment, because why it is so high is because we're responding to this, like we're growing. We're responding from the fact that we have increased production from shrinking by 6.2%. So in terms of dollar value, GDP isn't actually much higher than it was last year. Like realistically, dollar for dollar, it's only slightly higher, but it's because we're bouncing back from the fact that we shrank that it has increased so much. So we are beyond the goal, but economic growth is currently at 9.6%. Then we've got the inflation rate, which is 3.8%. We are mainly bouncing back from deflation that occurred last year. So bouncing back. So that just means that prices came back to what their original level was, but because prices went down by 0.3% last year, it makes it seem like prices have increased by a lot because they've gone back to where they used to be and something slightly higher. And so therefore inflation seems really high. But in terms of the goal, the underlying rate of inflation is about 1.6% at the moment. So underlying. And from that, what's also really important, that because our goal for low inflation is for the general level of prices to be rising at 2 to 3% on average over time. If you look at all this data, still on average, we're going to be below that 2 to 3%. Like if you were to draw a line average through all of that, it's going to be below that. So realistically, we haven't been achieving the goal. We are moving towards the goal. And because that 3.8% brings us up closer to being at the goal on average over time, we're not having too much inflation, like that's not going to have too much of an effect. And likely with the impacts of these COVID lockdowns that we're having, same with economic growth, it's likely that these numbers are going to shrink in the next period and be much lower, but those periods aren't going to be out before your exam. Then we've got the unemployment rate. The most recent unemployment rate as of this week is 4.6%, so it's gone up 0.1%. What's going to be really interesting is that next we are going to look at the labour force participation rate and how that ties in with this. The unemployment rate being the lowest rate of unemployment possible without any unnecessary inflationary or external pressures, around 4.5% of people being naturally unemployed. So we're right around that, numerically saying that because it's around 4.5%, you'd say data-wise it is being achieved, but why it's kind of a bit arbitrary is that if we look at the labour force participation rate, it has been shrinking a lot. So it means there are less people in the labour force. So it makes the unemployment rate seem smaller than it is because people just aren't looking for work. So rather than being considered unemployed, a lot of people just aren't looking for work. Less people are participating. In the space of 3 months, we've lost 1.7% of people from the labour force. So a whole bunch of people that would have been considered unemployed just aren't looking for jobs anymore. That's thousands upon thousands of people. And so therefore it makes the unemployment rate look better than it actually is. So although the unemployment rate and full employment is technically being achieved, a lot of people have left the labour force and therefore probably actually isn't that accurate. So our labour force participation rate is currently about 64.5%. That also limits our productive capacity as there are less people involved in wanting to produce. We've got less labour resources available, and therefore that limits our aggregate supply overall. All right, then we move on to our current account balance, which you can see has been in surplus since July of 2019, has been growing over this time. This is largely due to the fact we have a trade surplus, which we'll look at next, and the high terms of trade due to a recovery in China. The recovery of China means there's been a massive demand for Australian exports, especially our iron ore, and this has driven our current account balance to be in surplus. Also, low interest rates worldwide mean that net primary income has been relatively low because we are paying less interest on our foreign debt, and therefore there are less debits leaving the country, as well as there are less migrants working in Australia, so there's less incomes leaving the country to go back to their home countries. So we've got the balance of trade, which, like I said, has increased a lot because of that export demand. We are exporting a lot and importing a little bit less. The terms of trade, the same. So terms of trade being the ratio of export prices received against import prices paid. You need to remember with the terms of trade that quantities remain constant. So it's just about the dollar value we receive or the dollar value that we pay. So the quantities remain constant. Therefore, if the terms of trade increases, it just means we're getting more money for our exports and we're selling the same amount of exports. So when that's high, that means we're getting more export credits in, favorable for the current account. Also favorable for aggregate demand because there's more injections relative to leakages. So that's 127 for the terms of trade, which means exports have increased favorably relative to import prices overall. But the exchange rate, which has appreciated recently to about 74 US cents. Obviously, the impact of this is that it should be unfavorable for our exports and mean that we should have more leakages in imports. But demand for our exports has been relatively constant over time. But that's the impact that it should have when the exchange rate appreciates. Obviously, it's a bit lower than it was earlier in the year. And therefore, because it has decreased on average since the start of 2021, you would say that arguably that's favorable because our exports are relatively cheaper than they used to be. And therefore, that's going to be good for exports overall. And we're going to import less because it's more expensive to import, and therefore that is a good thing. They've got the cash rate. So the cash rate over the last 2 years got decreased to 0.1 in November of last year and has stayed there ever since. So monetary policy has been expansionary. Very, very important to know that if the RBA increased the cash rate to say 0.25, that's not contractionary policy, that's technically just less expansionary because a cash rate under 3.5 is considered expansionary currently. Also with the cash rate, your teachers may have taught you many different other things like the corridor and a few other non-conventional monetary policies. In terms of the study design, you only need to know about open market operations, so the RBA buying or selling government securities or government bonds to increase or decrease the cash rate. So knowing that the cash rate is currently 0.1 and the impacts that has on the various goals, very, very important. And finally, the budget. So the estimated budget for 2020-21 was 141 billion. However, their budget outcome ended up being 134.2 billion. So that's different. They expected to spend more on JobKeeper than they did, and there was a few things that cost them less. The estimated budget for 2021-22 is a deficit of 106.6 billion, but this could increase if we needed to predict how the budget outcome is going to go. All the Delta wave outcomes could end up having this be a larger sum because of all the COVID disaster payments that have had to go out, as well as the changing in government outlays for welfare and less tax revenue coming in from decreased sales. So some useful policies to know for the end of year exam, and the ones that I think are the easiest to use, are the lower middle income tax offset of $1,080. This is really great for saying increased private consumption spending in AD and therefore increased aggregate demand. The reduction in company tax for small and medium businesses is great for increased investment spending and therefore increased aggregate demand. And these just flow on to all the goals. So job seeker and COVID disaster payments just straight into increased consumption spending, increased aggregate demand. If you want to use these for aggregate supply, with low middle income offset, it would be about increasing motivation to work. So therefore that would increase the availability of labor and make them more motivated. So we'd be more productive. And therefore that would increase aggregate supply. With the company one, it means businesses would want to produce more. JobKeeper and Job Trainer tends to be AS based because it's going to make the quality of labor better and therefore increase our productive capacity, make us more productive, and therefore increase aggregate supply. The Westgate Tunnel project you can use for each, but it's a very useful one to be able to use about the fact that it clearly would have an impact on employment, clearly has an impact on efficiency and productivity. Childcare subsidies is the same, gets people back to work. Childcare subsidies is about motivating parents to return to the workforce and therefore increase our productive capacity. Make sure you don't use JobKeeper for aggregate demand because it is a wage subsidy. And because it's a wage subsidy, it's AS based because it's lowering the cost of production for businesses. It's not going straight into a household's pocket. It eventually becomes an income for people when they receive it, but the main impact of it is to lower the cost of production for businesses. And that's it for a very, very quick, brief overview of all of the important stuff for the exam. If you know a lot of this stuff, you're going to be really, really well in terms of how the economy is faring overall. So thank you for watching. If you want anything else specifically, let me know. Either comment below or Sean@therunningeconomy.com. Happy to make any other videos that will be beneficial to you between now and the exam, which is now about just under 4 weeks away or just over 4 weeks away. I don't know what time is anymore. I'm currently isolating because I was a close contact to a COVID case. So time is meaningless. I'm not allowed to go outside. I'm getting weird and isolated. I hope you're having a wonderful day. Good luck for your revision. Send me any questions that you might have, and I will see you next time.